Hi, everybody. My name is Dan Weisskopf, and here we are going to get started for the Think Tank Exchange in 2024, the first one of the year. We're looking forward to a great discussion with Mike Olson, who's the portfolio manager or a portfolio manager at Motley Fool Asset Management. So we'll give it a couple of seconds more for people to come on in and join us. And of course, Michael, thanks for joining us today. Looking forward to a great, chat, discussion, whatever you want to call it, about markets and companies more than specific stocks, but they're all interrelated, of course.
Yeah, thanks. It's great to be here. These are always fun discussions, and you guys, it's great to talk to people who are sort of like-minded investors and, when they get it. And so, it's always fun to talk to you guys for that reason.
Yeah, no, we have lots of discussions on a regular basis, and appreciate your participation in the ETF think tank. Okay, let's just get started. Right now, tell us a little bit how you came to Motley Fool Asset Management.
I'm just gonna go ahead and start off quick. Gotta hit the disclosures. And what I will say, this will be familiar to anyone who's listening to any of these things. All opinions expressed today are my own, do not necessarily represent those of Motley Fool Asset Management or its affiliates. My comments are intended for informational purposes only and should not be construed as investment advice or recommendation. Investing is risky and you could lose money. You should do your own research or talk to a financial advisor before making any investment decisions. NTHAM is an affiliate of the Motley Fool. NTHAM is a separate legal entity, and all daily operations and investment decision-making are conducted independently of the Motley Fool. Okay.
Oh, yeah. Okay. Now we can get, by the way, that disclosure is in the chat, as well as links to the website where people can find out more about the funds and the disclosure.
Right. I don't think you want to read that again. But now, to the Motley Fool culture and how I ended up here. So I've been in this business for about 20 years. I started at the Motley Fool sister company, publishing entity, and joined Motley Fool Asset Management about 5 years ago, where I work as a co-portfolio manager on the Global Opportunities Fund. I sort of focus on the international side of the portfolio, idea generation on the international side of the ledger, and I cover a smattering of companies across the international and domestic sort of realm. When I kind of, you sort of ask about Motley Fool culture and why the Motley Fool, I think one of the reasons I was drawn to Motley Fool Asset Management and remain here is, sort of when you look at the investment management business and the institutional imperative, which is basically just that, you are judged on your last good day or your returns. The sort of lack of institutional imperative at Motley Fool Asset Management is really what's drawn me here and keeps me here. I think there are, very few truly long-term investment shops left. And when I kind of, and when I think about investing and basically what we're attempting to do, I think that having a long time horizon patience is one of the few sort of truly enduring sources of edge in the investment profession. At Motley Fool Asset Management, we are generalists. We're a team of 9 people, and we're generalists for 2 reasons. First, we think that, when you kind of think about the institutional imperative, it avoids that sort of compulsion which derives from covering utilities, where you feel like you have to recommend a utility stock or something like that, or you want to own a utility because you cover them. For us, we are students of business. We love looking at businesses, thinking about businesses, and our goal is basically just to own the best businesses. It doesn't matter whether it's a utility or some sort of arcane corner of the tech universe. And we also think that there's power, and insight in reading broadly, because you kind of sometimes get insight from strange places. I mean, at its core, I love puzzles. I love investing. And I think, what investing can do for people, the power of compounding, it's really incredible. And so the opportunity to do something which can really, truly sort of help people, and to be a student of businesses, to kind of, be engaged in these puzzles on a daily basis is something which is, very fulfilling and interesting to me.
Love it. It's interesting. You talk about doing good for people, and you guys were early in converting from mutual funds to the ETFs. And for me, having been involved in ETFs for so many years, that was the right thing to do. I'm thrilled that you guys came into the ETF culture, and it's absolutely, clearly beneficial to people on an after-tax basis.
Yeah. I mean, I think, when you look at ETFs and you look at the tax treatment, and also you basically just look at, the fee schedule, which we can charge people, and, also maintain solid economics for our business. It's really just one of these things where it's a mutually sort of beneficial proposition. Investors do well. They get charged lower fees. The economics are great. And so, I think when you look, call it 10, 20 years from now, if the sort of preponderance of active and passively managed funds are not ETFs, that will be a sign, in my opinion, that something went wrong, or we figure out something about the construct that, is not necessarily as good as it looks. But, to me, it was just sort of, it's a no-brainer. And it also basically has the sort of peripheral effect of allowing us, I think sort of a core value for the Motley Fool Asset Management is transparency. And, we like the fact that basically, some people would say we don't want our holdings to be published every single day. For us,
Okay.
Right. Like the optimal investment horizon for us is 3, 5, 10 years. And so, being able to be transparent about our holdings and also having people see them on a day-to-day basis, that doesn't necessarily matter to us. And, we like the fact that we can be transparent about that.
Yeah. I used to laugh at some of the portfolio managers who's, well, I'm afraid people are going to front run my ideas. I'm like, yeah, front run. That's great. Sell, into the front run, whatever, move around your position. If you're a long-term investor as you are, it certainly doesn't matter.
Yeah. I mean, you're basically, to save all but the smallest companies where there's extremely limited float or something of the like, it's just, it doesn't really register. And even, unless you're sort of the largest of investors, Buffett or something like that. And even Buffett, like the Buffett pop, whenever you hear about something that he owns, would it have necessarily mattered in his Apple investment if it popped 10%, acknowledging how well it's done across very long periods of time? No, not at all.
Yeah, exactly. So talk to us a little bit further about how investment committees work. Now, I've spoken to a number of the portfolio managers and also the CIO, of course. But sometimes the interesting part that I've heard is people don't always agree. Right? There's lots of checks and balances. People write things down on their thesis, what their expectations are around a name. Talk to us, give us some funny stories about your investment committee meetings.
Yeah. So, I think, what we do is basically all investments that end up in the portfolios, there's sort of a vetting by committee. And there are really two parts to that. The first is what we'll do whenever we identify a company that is prospectively speaking interesting. We will write up what we call a quality write-up. And basically, we're evaluating how attractive it is on the basis of 4 pillars: management, culture, and incentives, the economics of the business, competitive advantage, and trajectory. And by trajectory, I mean the ability to kind of, either maintain or increase its slice of the economic pie across passage of time. And so what we do is whenever we basically, we do those write-ups, what we will do is evaluate and sort of score these companies on a committee basis in order to basically, and, what the reason we do this and the reason we have these discussions is we think there is power in the narrative process, being forced to go ahead and write whatever your conclusions are. So then, there's not any of this sort of revisionist history that happens where I think everybody has seen and certainly experienced that time where when an investment does not necessarily go as you would have expected, you engage in this sort of revisionist history and you kind of say, oh, well, maybe the thesis is this or something to like. What's written, you can't necessarily hide behind it. And the other part, which is important about basically presenting that work to a committee of your peers is, all of us, we've worked together for a very long period of time. And so there's certain power in that because we understand each other's ticks. And so, if I talk to our CIO, Brian Hinman, about a stock, he understands basically how I think about companies. He understands where I may be predisposed to have biases. And he understands then how to ask me the right questions. And so, we'll do that original write-up, and then we'll also have a thesis write-up. And that basically is saying, what is our theory of the case? What is the testable hypothesis around this investment? And what does the market understand or not about this investment? And then, you're also going ahead and you're putting your valuation assumptions out there and, the how and why of this investment. And there's, again, power in that because it allows, the ability to be challenged. And it also basically forces honesty on my part, because if I go ahead and I look at that thesis write-up, and it basically has gone dramatically differently, from a process standpoint, because a lot of investing, it's not necessarily, of course, about the outcome, but it's basically just having good process and understanding, creating good mental frameworks for evaluating investments. That's a powerful sort of way of creating accountability. I think the other thing, you talk about investment committee meetings. One thing we sort of pride ourselves on as an organization, is being a flat organization. I'm not necessarily concerned about the fact that, one of our analysts, I'm happy to have them challenge me and tell me I'm wrong, because I think ultimately speaking, that makes us better. I think the investment management profession, there's sort of a general obsession with being right. And that's not necessarily the right focus if you want to have a sort of growth mindset across the long term. Obviously, we want to be right more often than not, but sometimes you need to be wrong to get there, right?
Yeah, and I've often said the market will make you humble, right? And it's what you don't know that can really screw you up. And anybody who doesn't recognize those realities as a person isn't necessarily going to grow, but they're not going to be the best investor, as well. I totally agree.
Yeah.
What you're saying. So let's talk a little bit about international, because I think that's your focus, right? The TFMG. Why does somebody want to think globally right now as opposed to just the U.S.? Because quite honestly, there's a home bias to our audience, right? But then also the U.S. seems to be the only place to be for most people. And, well, that's not necessarily right.
Yeah, no. So, I mean, I think to kind of provide like a little bit of framing assumptions here in terms of how we think about investing and basically like important qualifiers. I mean, I think the way we sort of think about investing as a shop is, we kind of have three sort of girding assumptions here. First, if you basically look at history and sort of market returns, and this is well beyond the sort of like big tech era of clustering of returns. If you look at that, a small group of companies driving overwhelming proportion of total market returns. The second thing is if basically you look at research around quality, and these are businesses that generate consistent profits, high margins, high returns on invested capital or returns on equity, that is a factor. If you basically identify high quality enterprises, they generally speaking deliver market beating returns across long periods of time. And the last is basically that, individual stock returns, they generally speaking aren't linear in nature, but skewed. And so you have to be a long-term investor. And also if you want to basically capitalize on the sort of compounding effects of high quality businesses, you have to be invested for the long term. And really, if we were to kind of reduce this to, a few things, it's basically just that there are a very small number of great businesses, statistically and otherwise. And the market, sort of understands and appreciates that. And there is reversion to mean in terms of the embedded assumptions and valuations. And so if you can identify these businesses and be invested in them for really long periods of time, that is a powerful advantage and sort of a powerful variant view. So let's just go ahead and then apply this to international. Why would you want to be invested in international? 80% of global GDP is outside of the US. And so in a sort of de facto sense, if you're trying to identify great businesses, the US is not going to have a monopoly on great enterprises and great businesses. And so in global ops, where I am a co-portfolio manager, one of three, our goal is to own the best 40 to 50 companies in the world, no geographic restrictions. And so, what you want to do is look globally here. If you think about like a good sort of practical reason for wanting to look globally also, is basically when you think of equity investing and the equity investing culture, which exists in the United States, there's sort of a general view or sort of perception that everyone is, invested in individual stocks. And if you look globally, the equity investing culture, the allocations to equities is not nearly what it is in the United States. And so the sort of practical ramification of that is, international markets, generally speaking, end up being cheaper. There are in part structural reasons, but they're also, it's also likely the result of that. If you want to put a little bit of context around that, at least call it right now, S&P is trading for about 20 times forward earnings, which, on any sort of historical basis is a little bit elevated. The MSCI All Country World Index ex-US trading at about 11. And so when you kind of combine those things and you basically think about lack of, sort of equity exposure in many international companies, and then these valuations, what you find is if you are looking for high quality enterprises, they're going to be a little bit less combed over. And so companies that would, might otherwise have a sort of higher multiple in the US just because of the attention they get, not necessarily the case on a global scale. And, you could say, okay, well, maybe this is like a company where there are poor demographics or there's high debt to GDP. It's an emerging market now. A lot of the companies we are often looking at, these are global enterprises that sell into an extremely global customer basis. But they just happen to be domiciled internationally. And last bit, which you'll go ahead and say, as you brought up, it's often said that, international has underperformed for, I think it's like the last 2 decades or something like that, or at least 15 years. If you look back across history, there are pronounced cycles of under and outperformance in between international and domestic markets, sort of trading the baton. And so I think that, if you're a long-term investor and you basically are also constructing portfolios where you want to go ahead and, to whatever degree possible, have some measure of ballast, it's responsible then to consider these other markets for the diversifying effect they have.
So I'm going to call you out on something because you use the word quality multiple times.
Mm-hmm.
Define it, because nobody comes out and says, I want to buy junk. Right?
Sure.
I really want to buy crappy companies. What is your definition of quality?
I think if you wanted to kind of reduce it to one thing, when we research companies, what I try to do is very sort of deeply understand how they interface with all their stakeholders, and basically how the product itself or products are used by their stakeholders. And the question that, intrinsically speaking, I want to have an answer to is, if its customers woke up tomorrow and this business didn't exist, would that impart considerable pain upon them? And if the answer to that is yes, then you can reasonably speaking assert there's pricing power in this business. And if you wanted to maybe kind of take a more granular view of this within the context of those pillars I said, so management, culture, and incentives. Basically, what I'm thinking about here is there sort of a high say-do ratio in management? Basically, whenever they go ahead and they say something, do they deliver upon it? And where externalities exist, is there a good reason? Do they have a good history of sort of intelligently and responsibly allocating capital? Are the incentives aligned in such a way that basically they will best advance the interests of, stakeholders? When you're thinking about economics, basically, this is sort of the story of a dollar of revenue. Are they, is there recurring revenue? Do you have attractive unit economics? Where there are not perhaps attractive unit economics, say this is a capital intensive, low margin business. Does that in fact create a sort of de facto barrier to entry? Of course, all these things sort of play together, right? But really, the optimal or the ideal when you're thinking about economics is you'd love to see recurring revenue. You want pricing power. You want high margins. You want high returns on invested capital. You won't always have that. And that's okay sometimes. But basically, those are sort of, what you're trying to do there is understand the unit economics. Competitive advantage. And this is basically, you're asking yourself, how and why is this company intractable? If you can't answer yes, that can be problematic, or that is problematic, in fact, because then basically there's no way to go ahead and sustain those returns. The last trajectory, really what we're asking ourselves here is, what is the arc of this company across the next 5-10 years? How and why will it capture at least a sort of equivalent slice of the economic pie? Optimally speaking, a larger slice of the economic pie across passage of time. And then, in all of these scenarios, we're basically trying to understand why, because all of these things are sort of fruitless if you don't understand, the sort of interplay of all these things.
And TFMG is about 50% weighted towards the US, and then next country is Canada. That's not really, you guys don't purposely stack your portfolio towards MSCI or world, right? This is coincidental, or how do you look at the geography?
So by prospectus, we try to be about 50% US, 50% international. Outside of that, and that can sort of fluctuate. Sometimes it can maybe be 40%, 60, whatever. Yeah. But outside of that, when we think about geography, what we try to do is we try to avoid undue weightings to any given country where we're sort of gratuitously overweight. But after that, we don't really necessarily let geography inform our decision. What we're really trying to do here is we're trying to find excellent enterprises. And, if it happens to be headquartered in Canada, that's fine. I think the other thing, and, you kind of said something about, appreciating what you don't know. Within the confines of international investing in particular, I think 3 of the most powerful words any given investor can say is, I don't know. In a lot of economies, the sort of incumbent challenges which come with sort of evaluating, the emergence of a given emerging economy, governance issues, sort of cultural nuance that one, simply speaking, cannot appreciate. There's often a lot of value in basically just saying, this is too hard. And it's really important to go ahead and stay in your circle of competence. And so, if you kind of think about this as sort of a Venn diagram, the 2 sort of really important filters there are not necessarily what country it is the same, but is this a high quality company? And then secondarily, basically, does this sort of fit our circle of competence? Or, how and why does it not? If so, I mean, we owned the large Chinese tech companies. And what we ended up doing was basically when we saw that she was really kind of coming down hard on these enterprises, and that basically there was going to be sort of a sucking sound of the economic profits. What we sort of asked ourselves is, for a lot of Chinese companies, to what degree does rule of law apply? And then, is it smart to go ahead and apply a democratic sort of capitalist frame to evaluating businesses where the sort of table stakes there, it's not necessarily the rule of law exists, or it's much different than basically how we would sort of fashion it and view it in the West. And, that's not to say we won't change our mind at some point regarding that, but that's kind of an example there of basically that filter and how it works in terms of circle of competence.
So we're going to go to the fun part, at least for me, the most fun part of the show, where we start talking about individual holdings. And when I'm listening to you, I'm thinking very much about how Amazon compares to Mercado Libre.
Yeah.
Walk us through, in the context of the four pillars, how those individual names stack up.
Right. So, I mean, I think, I couldn't give you the exact scores off the top of my head.
Yeah.
But what I can say is basically when we originally scored Amazon, it came out as one of the highest scoring companies in our universe. Mercado Libre, in many respects, when you kind of think about the underlying enterprise, it looks very similar to Amazon with a twist though. Which is to say that basically, its marketplace business is effectively speaking Amazon for LATAM. It has a little bit more of a three-piece slant, which I think we like because the economics are intrinsically more attractive right there. And, e-commerce adoption in LATAM is much earlier. You talk about basically international. It happens that I cover Amazon and Mercado Libre. What we're often trying to do basically is, I'm very obviously American. I grew up in New Jersey, for those people who might have kind of picked out that accent every now and again. But we're trying to use that insight that you get from looking at being a student of businesses and see how that can be applied elsewhere. And so basically, you look at Mercado Libre and there are, of course, ready analogs, and there's much insight to be gained by following Amazon and also looking at Mercado Libre. The other part of Mercado Libre is Mercado Pago, which is effectively speaking, one part payment processor, one part financial institution, one part sort of MasterCard Visa. And what you see if you do research on LATAM is there is a very large underbanked population. There's a lot of friction. There's oftentimes, credit card transactions don't go through or things don't work. And so Mercado Pago is basically born of, sort of Mercado Libre's frustration with transactions not necessarily clearing or working. And what it's become is really become sort of a behemoth and a powerful economic profit engine. It's really, in many respects, it's sort of a hybrid of sort of PayPal and MasterCard and Visa. And what Mercado Libre has done and management has done really quite intelligently is they have been a student of many Western enterprises, and Eastern, of course. I mean, I think they borrowed a lot from the Alibaba playbook in seeing what works, basically, and then harnessing the power of the network effect in their business to go ahead and kind of increase their slice of the economic pie. And, I think, in an economy in sort of region which is characterized by incredible geopolitical uncertainty and, sort of continuous governance strife, it's amazing what that business has done. And it just speaks to the sort of strength of vision and basically the nature of the sort of untapped opportunity which exists there.
And when I think about Amazon, I also remember that there were periods of time for years where they weren't making any money, right? And they were being criticized for that. Would you own an Amazon or a company that is not making money? Is that a requirement for you?
No, I mean, that's not a de facto conclusion right there. I mean, I think, in an optimal world, I talk about high quality businesses, but the sort of ideal is you own a business which is perhaps not considered to be of incredibly high quality, but will increase its sort of quality across passage of time. And if you can do that, that's a sort of very powerful driver of returns across long periods of time. And, in Amazon's case, one of the things that I always thought was sort of a competitive advantage and a superpower for them is the fact that they had basically given themselves license to not make money and to invest very aggressively in that business. And, Amazon is sort of traditionally thought of as a tech company. But really, their advantage is in the physical, at least in the e-commerce business, which is to say that the sort of the challenge to build a comparable distribution infrastructure and get as close to those customers, that's, straight up a brick and mortar advantage. And what they have done there is basically the sort of inherent challenge in e-commerce and profitability is closing that last mile, is making the economics work. And, they've gotten closer and closer to the customer, and they've continuously sort of automated those processes. You can say a similar thing in terms of the original genesis of competitive advantage in AWS, which is that data centers are incredibly costly to build. You're talking about $1,000 a square foot, sometimes $2,000 a square foot. I mean, those are the most expensive examples, but basically the fact that they invested very aggressively behind that and then relentlessly drove prices down, and then also basically built an ecosystem and software around that, was a sort of very powerful source of lock-in. I mean, one great story, don't want to take people away from the think tank, but if you like really long podcasts, listen to Acquired in the Story of Amazon. And they talk about AWS. It's a 3-hour episode, so don't do it if you're driving somewhere with your wife in a car. She might not necessarily love you for that. I did it when I was not. But basically what they talk about is when people sort of moved their data from a sort of in-house data center to AWS, Amazon would actually take tractor trailers out to these data centers to go ahead and move them. And so, you again, when you basically think of that, that's a really powerful sort of physical advantage in terms of the competitive advantage which exists right there. And that's, switching that is costly and oftentimes quite disruptive.
Yeah, no, it's funny because I live in New York City, and I could basically go downstairs from my apartment and go to the drugstore. It takes me three minutes, right? But I'll still order stuff on Amazon because it's just simply part of my own DNA every day, where it's easy. Okay, I need batteries, I'll just order. And then I start wondering, if I order small things, are they really making any money on the individual order, right? But
right.
It's about the relationship and getting into the repeat business. And at this point, I think a lot of people, couldn't live without Amazon.
No, I mean, we lived in DC for 7-8 years. We recently moved just across the river. But this sort of power of habit right there in terms of just saving time, and then also the sort of value embedded in that Prime membership. I mean, I think, I don't know that they'll necessarily take advantage of that sort of pricing power which exists there, but that's effectively speaking a digital utility for me. Like, if they were to go ahead and tell me they were raising the prices 20% tomorrow, I can't say I'm representative of the average person, but I wouldn't even flinch. When you basically think about the utility of, you think about something you need, it's, call it 11 o'clock at night, and you're about to go to sleep, and you're like, I forgot to buy this. Like, I'm going to hear it. And then you just lob in the order, and it's there tomorrow morning. And the strength of this sort of logistics network that Amazon has built and that infrastructure, it's just so hard to replicate. And, then when you basically think about that within the context of the Prime revenues and the membership fee, you could call the Prime membership fee a subsidy on these shipping costs, or you could call it very high margin incremental revenues. However you want to go ahead and think about that, they could go ahead and raise that. I mean, for that convenience alone, they have a real license to raise prices there.
And sometimes it's not so obvious, but like in the context of the batteries, as an example, I just bought Amazon batteries, right? So they're branded Amazon as opposed to Everready, right? So they've got to be getting more margin
100%,
out of those kinds of products. So is that kind of a lesson that a Mercado Libre will be looking at, would you guess?
So when I think about, this has of course been controversial because they're the EU compliant around 1P merchandise, and sort of own brand merchandise, particularly on Amazon. I think that when you think about 1P merchandise and particularly own brand merchandise, there are maybe really two reasons you can do this. I think the profit dollars on a 1P We've looked a lot at, sort of the profit dollars on a 1P order versus a 3P order. We're getting kind of geeky right now, but that's basically 1P is when you own the merchandise. 3P is basically when guy who has a business, he basically owns the merchandise, and Amazon just takes its typical sort of rip on that. And that can vary, it can be anywhere as low as call it 10% to as high as 30% if it's a full sort of fulfillment by Amazon type order. But basically the profit dollars on that are the same. And so I think the reason why Amazon so sort of aggressively, the antitrust allegations basically allege that they are just going ahead and forcing prices lower and that they are basically taking the air out of the system. That may be the case. I think the reason to do this from a sort of business perspective is it increases the depth of the marketplace. It basically forces, basically velocity, and it forces competition. And that in turn, then basically, because the real sort of power of Amazon and, perhaps Mercado Libre, I obviously haven't shopped on it because I live in, Virginia. But I mean, if you look at the surveys and you look at, in terms of depth of marketplace, the real power in this is basically just that, I run, I cycle, and I obviously have a lot of other things. And it's just I can go on Amazon, and if I basically need something for my bike, I can oftentimes get that. I can get foodstuffs, I can get clothing, I can get whatever your random sort of good is. And what you want is that depth of marketplace so it creates the habit. And then there's sort of a self-fulfilling prophecy around that. I think that was why Amazon originally, went into 1P. Well, they were also sort of forced at the beginning because they basically had to create the marketplace. But, why they've sort of stayed in that. And for Mercado Libre, they've recently announced that they're sort of expanding their 1P merchandise. And I think that's the reason right there. And also basically all else equal, if you can basically deal in high velocity goods, the worst case is you get stuck with a lot of inventory and it becomes, more working capital intensive. You don't want that. But if you deal in high velocity goods, the profit dollars are basically by and large the same. And so if I'm basically just thinking about this in terms of doing the best for my customers, it's neither here nor there. You just want there to be depth of marketplace.
Yeah, and you can almost get anything in. At least I think about that at Amazon. Almost anything, So sticking with the technology theme, Equinix.
Yeah.
Talk to us a little bit about that company and how its relationship with NVIDIA works.
Yeah. So Equinix is basically, so they are a data center operator. And basically there are kind of maybe several types of data centers. They're the data centers you think of when you think about Amazon, which are what we would call wholesale data centers, hyperscalers. And basically what they do is they are these huge sort of server farms where a lot of data is stored. And, really what matters most in that business is low cost. For Equinix, what they do is they have built data centers, and they, generally speaking, locate these at sort of key internet connectivity points. And what they endeavor to do is facilitate more efficient exchange of traffic in the internet. And so best sort of analog I can go ahead and draw here is if you want to go ahead and say you think about an airport, and you basically have the option of, a good friend of mine recently just went ahead and he moved to Argentina, and he flew from DC to New York and then to Buenos Aires. Obviously not particularly efficient. What would have been better is if, and it was probably just because of the airline or whatever you will, what would have been better is perhaps if he had flown from, call it DC to maybe Mexico City or Miami and then to Buenos Aires, because then you're not going up and down, whatever you will. Now, what happened with the internet in its sort of early days is what would happen is you would have traffic that would bounce between these various server points, and it was highly inefficient. Sometimes I would go ahead, my website would ping a server in Japan, even though I'm right here in DC. And so what Equinix basically sought to do is, so sort of all these key internet stakeholders, Amazon Web Services, the telco providers, large multinational corporations, financial services providers, whatever you will, they would all put maybe a couple of servers in an Equinix data warehouse. And basically what that meant then was you didn't have this traffic bouncing from one point or another. You basically created the equivalent of an Atlanta Hartsfield. And it made it so that traffic exchanged much more efficiently. And so that was the sort of original that is the genesis story of Equinix. If you want to read a book, get really dorky on this, there's a book called Tubes, and it is sort of a history of the internet. And Equinix features very prominently in it. It's a fascinating sort of look into what Equinix does. Now, Equinix has basically established itself. They're a worldwide data center operator. And what they are known as sort of being their bread and butter is basically facilitating interconnection, facilitating more efficient exchange of traffic. And so what they are indexed to is A, growth in cloud workloads, because of course then more traffic is moving across the internet, and B, growth in data itself. And so the reason we like Equinix is basically their role in the internet is they are sort of a key exchange point. And that is something which you really can't necessarily disintermediate. And in addition to that, when you think about the growth in data, which has occurred as a function of the sort of growth in cloud workloads, it's basically, there's sort of a Jevons paradox effect here, where basically use cases beget use cases. And so you can have extraordinary growth in data for much longer than people would necessarily have appreciated. If you look at other sort of societal innovations along these lines, you look at like electricity, you look at vehicle miles traveled, basically as the cost went down and as the technology itself advanced, you found new use cases, and you basically also had very high rates of growth for much longer than anyone would have sort of traditionally speaking expected. When we look at Equinix right now, basically depending upon geography, maybe 30 to 50% of workloads are in the cloud. We think that can increase to maybe, at least 50%, maybe upwards of 60 to 70%, because basically having a third-party data center is much more efficient than having it on site. And then you basically also just look at the growth in traffic that's going to occur. And we think they can grow for a long time at very high rates, or not very high rates, but at least 8 to 10% rates as a sort of function of that. How they relate to NVIDIA. NVIDIA, basically, their GPUs are basically facilitating the sort of exchange and processing of ever more complex data workloads or data. And that is going to facilitate, when you look at AI and, not necessarily AI, but call it the next iteration of big data, if we're going to go ahead and date ourselves, that is going to facilitate more use cases, more data, and Equinix basically being that exchange point, the sort of Atlanta Hartsfield of the internet. That's like what I like to call it, at least within its respective markets. They're going to continue to take a toll on that. And the other thing, of course, is basically, Equinix, they're, plus minus 80% utilization in a lot of their data centers. As you basically fill those data centers in, this is probably about, call it a 60 to 70% fixed cost business. There's tremendous incremental profitability on, that additional unit of revenue right there. And so for us, when we basically think about those spaces filling out, this is already a business that does maybe, high 40s, maybe close to 50% adjusted EBITDA margins. We think they can basically converge on, the 60% threshold across passage of time, which, for business, which is pretty labor intensive. And, okay, you want to go ahead and then say, what are their cash margins? Because this is a data center. You've got a lot of capital intensity in that.
Yeah.
Their cash margins, the AFFO margins, they're 30% too. So this is just, and you're going to see those go higher across passage of time. And so, we sort of think of Equinix as in sort of a very similar to fashion as you would to the tower cos, the cellular tower companies, and that they basically are just sort of a digital landlord, and they're going to take a toll, regardless of what the sort of manifestation is.
You just read my mind, actually. I was going to go next to American Tower. Is it a technology company or a real estate company?
Right. I mean, and yeah, I think it's both, right? Like, I mean, it's basically, the beautiful part about that is basically, American Tower doesn't necessarily care what the technology standard is. Basically, all they care about is that mobile data consumption continues to increase. And, so long as mobile data consumption continues to increase, you're basically going to go ahead and see more equipment being hung on these towers. And then you're going to, you have very high incremental margins on that. And so for them, each incremental dollar of revenue basically comes at 90% incremental margins right there. And that's the sort of business where I would say they are indexed to, very important technological changes, but the sort of rate of change in that business is not going to be nearly what it would in the average technology business. And, for many technology companies that appear to be moat-worthy right now, you could go ahead and say, oh, well, are they going to look the same in 5-10 years? You can't necessarily say that with confidence. With American Tower or, Equinix, I can say that with a much higher degree of confidence.
The boxes are going to be there. Yeah, no, and the business model is going to be consistent. And by the way, the interesting part about this discussion for me is, believe it or not, I'm thinking about railroads now. The railroad industry isn't going to change, right? It's going to be the same. You guys are long Canadian Railroad, right?
Mm-hmm.
Talk to us a little bit about that name. Obviously, it's totally different than Amazon, but it's moving some of the goods.
Yeah. And so I'm thinking about this as I speak. I should go ahead and disclose I own Amazon. I own Equinix, and I also own American Tower. So eating that cooking there. So for Canadian National, I think if you again going ahead and directing people away from the think tank, shame on me. But there is an not invest like the best, but business breakdowns on Union Pacific, which is not a Canadian road, but a railroad which does an excellent job of basically going ahead and detailing how and why these businesses are special. But basically, what it really comes down to for Canadian National and all the Class 1 rails is these are 100-year assets. Canadian National has literally issued 100-year bonds. Now, there is not a more powerful sort of indication of a competitive advantage, or what I would call a competitive advantage. Please go ahead and show me. That is the market effectively telling you there is something about this business which cannot be replicated. When you think about this on a sort of practical scale, Canadian National, it has a tri-coastal network, and that is to say it touches the Pacific coast, it touches the Atlantic coast in Halifax, and then it touches the Gulf. Basically, the cost of going ahead and building a rail infrastructure and getting sufficient utilization makes it such that there's just no practical sense in it. And so all the Class 1 rails, they basically operate as duopolies or sort of monopoly in each of their respective markets. And that's Canadian National does. The reason we like Canadian National is basically we think, historically speaking, or not historically speaking, but over the course of probably the past 5 to 10 years, they pursued growth at sort of cost to margin. And we think the new management team basically has received the message on pursuing profitable growth. You've heard me talk a lot about businesses that basically have very high incremental profitability. The cost of basically adding a unit of revenue or another carload to a rail, very low. And so what we think basically, is generally speaking underappreciated about Canadian National. We think it's well appreciated the fact that there's the potential for operational improvements. Across very long periods of time, we think the ability of rails to sort of semi-continuously increase their margins is not well appreciated. If you're a student of rails, there was a period in time where they refer to the operating ratio, which is basically just the percentage of operating costs relative to revenue. There was a period in time where sort of the upper limit on what an operating ratio could get to was thought of as sort of 80%. And so 20% operating margins. Then there was a period in time where it was 70%. Now the rails are all sort of in the high 50s range, and people are saying, you can't really necessarily do much better. I think that basically, if you understand the sort of unit economics of this business, there's going to be very high incremental profitability for much longer than people, generally speaking, appreciate. The other thing, which we don't think is necessarily appreciated in all of the rails, is basically just these are businesses which, they're not going to blow the lights out in terms of their growth, right? Like at best, this is probably called a 1 to 2% volume growth business. If you believe in reshoring, maybe it's call it a 2, 3, 4, 5% growth business or volume growth business. What that means is they basically have relatively fixed capital sort of intensity. And this is a business that basically does 40% operating margins. So there's a lot of cash that gets spit off. And we think that basically for Canadian National and all the rails, there's going to be a virtuous cycle from share repurchases, because that is going to be a semi-continuous use of capital, unless they basically, of course, the shares are gratuitously overvalued, in which case we would hope management doesn't repurchase shares. But if you look at all of the rails, they have sort of pretty continuously returned capital to shareholders by repurchases. And basically, that is a source of incremental return that is not necessarily appreciated in the share prices, we think.
Switching up a little bit, Universal Music. Talk to us a little bit about that, because that seems like a very different company than the companies we've been speaking about.
Yeah. So the reason we like Universal Music is basically we think this is a sort of higher growth for a longer business. We think that music is perhaps one of the most, it is a highly under-monetized content asset. So Universal, for context, they're the largest recorded music label. They have about 30% global share. And for a long time, basically, I'll go ahead and reveal my age, but I basically remember when, the sort of death of music occurred, which was when I was in college, and Napster came to exist. And that was when you basically had pirating of music. Then you pivoted to, digital sales vis-a-vis iTunes. It was also not necessarily great for the business, just because you still had piracy, and you also it wasn't necessarily a recurring purchase item. So you basically had a sort of almost 2-decade period where the music business was not great, and they basically got their lunch eaten. Now, with the emergence of Spotify, with the emergence of Apple Music, with the emergence of Tidal, whatever you will, what was historically speaking, sort of a hit, make, break business, it has become a membership business. It has become a recurring revenue business. The reason for that is basically Universal Music, as a function of its sort of place in the value chain, what they do is that Spotify subscription you pay for, basically $6 of your $10, it goes to Universal Music. And they are a toll taker on that, just because what Spotify needs is they need access to Universal's catalog. Without Universal catalog, Spotify's service itself is basically useless, because 30% of recorded music is going to go away. So their toll taking ability is basically, I would argue, more or less unparalleled within the context of the sort of that sort of digital space. The reason we like it is basically, if you look at household penetration of streaming services on a global basis. We think there is meaningful upside there, particularly in EMs, but also to some degree in developed markets as well. And basically, as you sort of continuously monetize that catalog and you get incremental subscriptions, there's very high incremental profitability on that. So you're going to see a period where, as that the sort of penetration of streaming continues to increase. Right now, I think we're at about, I think it's about 600 million globally. If you look at sort of an analog, which is paid TV concentration at its peak, it was at about 1 billion households. So we think it can go at least to that point. And then I think the other thing, which is basically sort of an emergent source of high margin revenue, is basically as people get locked into the digital service providers, Spotify, Apple, whatever you will, you have your entire catalog, sort of locked in there. And what they're learning is they have pricing power. And basically for Universal, that 3% bump has very, very high margins right there, or a 5% bump, whatever you will. So, long term, we basically think this is just a tremendously valuable set of content assets. And we also think that basically because of the nature of music, it favors scale. You're basically making a lot of very small bets on artists. And so you need the ability and the A&R infrastructure to make a lot of bets. And also then from an artist perspective, there's something which is attractive about basically having this sort of might of a Universal behind you relative to sort of an indie label. And there are puts and takes to having an indie label or a large label. But so that's kind of a sort of somewhat windy, and roundabout way of talking about, how and why we think that is interesting. But, we think they can basically grow cash flow at double-digit annualized rates or high single-digit annualized rates for a pretty extended period. So we're big fans of that business there. We think that's sort of real toll taker asset.
So before I forget to ask what might end up being the final question, we've talked a lot about what you own. What have you sold recently? And why? This might be sort of this might be in its own way representative of our ethos, but I can't think of something we sold relatively recently. We had 7% turnover last year, and a lot of that was basically just moving around the edges in order to allow positions and new positions to be added. I think if you want to kind of generally speaking talk about the sell ethos right here, sure. There are probably 3 reasons we're going to go ahead and sell. And our CIO, Brian Hinman, will talk much more eloquently about this than I. But the first is basically the business quality is not what we thought it was, or meaningfully speaking degrades. The second is sort of a busted thesis. And basically by that, we mean just like whatever our sort of notion of the hypothesis was, it has gone awry. And, there's often some sort of power in selling because it unanchors you from your priors. And the last is basically, and we try with the sort of sub-businesses we own to give them some sort of leeway, is valuation. Example, actually, as I think about this, of a business we sold last year is Jones Lang LaSalle. And basically, the reason we had owned that business was we thought the large sort of commercial real estate services companies would increasingly benefit from outsourcing of basically the commercial real estate management function. And the sort of largest commercial real estate service providers, their ability to offer a bundling of services would enable them to capture sort of outsized share and to grow sort of in excess of the market, and then to offer sort of additional and incremental services. The reason we sold was basically, we think that we spent a lot of time looking at office markets, and office is but sort of a small part
of the sort of entire commercial real estate high. But for JLL, in terms of its high margin revenue streams, it has pretty large exposure right there. And what we thought, we think that basically like the work from home thing, there's a reason you and I are doing with these calls with this backdrop, and it's not because our offices are not pretty. It's because we aren't at our offices. I think, there's a place for office, but basically if you accept that work from home is going to be a thing for call 1 or 2 days a week, the sort of cascading effects of that on office valuations are going to be very pronounced. For JLL, they had a very large leasing business, which was very high margin. And they also basically had a large outsourced property management business, which was also pretty heavily weighted to office, we think. And so when we kind of looked at the valuation there, this is a stock which, outwardly speaking, seemed cheap. We didn't think it necessarily reflected that possibility. The other thing, and this is basically kind of goes to the sort of power and saying you don't know, one thing we sort of realized was the sort of range of readily ascertainable prospective outcomes. It was pretty hard to wrap our heads around that. And, when we sold, we didn't necessarily think that the share price adequately gave effect to it. I still think that JLL is a great business, but basically if one part of sort of owning any given business is your ability to, not have a sort of point estimate on prospective outcomes, but understand the range of outcomes, we felt as if that was, that had become much more open-ended than it was when we first bought the stock some years ago.
Yeah. Michael, thank you very much for being on the show. Appreciate all that you guys do at Motley Fool Asset Management, and keep up the good work, right? It's not always easy.
No, it's hard work.
Be well.
Thanks for the time.
Thank you.